Holy smokes, everyone. I'm on the road today. I wasn't planning on making a video today, but we've got some huge news that happened in the markets over the past 24 hours. But I also want to go over something that I've been thinking about lately. And what I've been thinking about lately is that cash is going to become king again. We've seen people take on huge amounts of debt. We've seen the gamblers in the markets. They've been rewarded over this past decade by speculating, taking on huge amounts of debt. But the people that have been responsible, that have been saving, that have not been taking on amounts of debt, that have not been FOMO, they've really been getting punished. They've lost purchasing power by putting their money in the banks, and they haven't been able to enjoy this bull run because they didn't want to gamble in the markets when it was so overvalued. They didn't want to take on humongous mortgages of $500,000 to $1 million to buy these overvalued homes. They didn't want to enter into these huge car loan repayments. We saw in the US, we just got some new news that the average car loan repayment has hit a new record high of $750. So that is just absolutely insane. People paying, $2,500, $3,000 a month for their mortgage, then paying $750 for their car repayment alone. That's someone's average salary, just 100%, just on the car and on the home loan repayment, let alone fuel, groceries, utilities, which is absolutely skyrocketing right now. But again, want to go over the markets today. Some huge things that are happening, some warnings from some huge corporations. So let's not waste any time. Let's get straight into it. So I'm sure, as you know, the markets closed down lower again today. The indices down close to 1%. They were down a little bit more early in the day. We're continuing to see yields on bonds rise, and they're getting to some pretty critical levels. The 6-month and the 2-year is getting close to 4%, and the 6-month bond is higher than the 10-year. That's how you know things are going really bad in the economy, everyone. If the 2-year and the 10-year have been inverted this long, it's been over 2 months now. Now, normally what's happened over the past 50 years is the yield curve has always happened before a recession. But we didn't just invert there for a little while, which we did earlier in the year. We have been inverted now, a steep inversion. It went nearly 50 basis points at one point for over 2 months, and it's still inverted. So that's a bad warning. The bond market is sending us some warnings there to say that, yes, we are in a recession and it's going to get worse. Now, also, we're continuing to see gold and silver selling off. Cryptocurrency sold off very strongly. Bitcoin struggling to stay above 20,000. We saw the Ethereum merge. That's when Ethereum went from proof of work to proof of stake. And it just, it's a classic buy the rumor, sell the news event. As soon as the merge happened, or shortly after the merge happened, Ethereum plummeted over 10%. So all markets across the board, stocks, bonds, cryptocurrencies, gold, silver, they've been getting wiped out as the dollar surges. It's bad news for gold and silver, but I do think once the economy really takes a turn, and there's a really lot of fear in the markets, people are going to go to a safe haven like gold, like what they did in 2008 and like what they did in 2020. But when there's margin calls, when there's a lot of fear, and when there's a liquidity crisis, just everything gets sold off. And that's what we typically see with gold and silver. They sell off during the crash, but then they recover shortly after, and they recover normally before stocks do, and cryptocurrencies. Also, there's a huge warning by a huge company, FedEx. Now, their stock crashed over 21% today, and they gave some pretty bleak warnings about the economy, and they saying we're going to enter into a worldwide recession. And what we're seeing now, and what's spooking investors in the markets is we are now going to be entering into an earnings recession. Something that I've been talking about was going to be the second phase of the market crash. First, we had interest rates going up, but then people saying, don't worry, the economy is strong, the consumer's strong, the consumer's balance sheet is strong. There's nothing to fear, people are still spending, retail sales are going up, which again, the only reason retail sales are going up slightly, it was like up 0.3%, is because of inflation. When you take out inflation, really in real terms, retail sales are falling. It's just that people are paying more for the stuff that they're buying. So they came out with a warning saying it's going to be a worldwide recession, and their earnings are absolutely collapsed. And this is something, again, I was talking about. Interest rates will go up first, like I said, and then once the economy really starts to enter into a recession, and once people can't afford any of these discretionary items because all their money's going on rent, rent is skyrocketing, and this is the biggest reason why the CPI is rigged, because the CPI is saying rents are only going up 6 to 7% per year, where we all know rents are going up in some areas 20%, even some areas they've gone up 30% in a year, specifically like New York and Florida, etc. So people don't have the discretionary spending. FedEx is a company that really tells you what's going on with the economy because people buying online, people shipping things around. So if they're struggling, the whole economy is struggling. And really that's what we're going to see in the markets, which is going to create this phase 2 of the stock market crash, is companies' earnings are going to have to fall. And for those of you who don't know, there's something called a price to earnings ratio. Already, even with this recent downturn of around 20%, the S&P 500 was about to dip into bear market territory again, but we saw that Wall Street really wanted to close above that 20% year-to-date contraction. We're down about 19.5% year-to-date in the S&P 500. But once companies' earnings start to fall, they're not going to be able to justify these high valuations. Before they're saying, don't worry, we can justify these high valuations because earnings is going to go up. Well, I think we're going to see earnings fall just like FedEx, and you're seeing FedEx got absolutely hammered today, down 21%. Now, something I want to talk about as well, something I've had on my mind, is cash in this crash and this possible depression we're going to face is going to become king again. We've had over the past 10 years, or really over the past 14 years since 2008, we've had people just taking on more and more debt. We've seen people, just take on mountains and mountains of debt. They thought that interest rates will only go lower. They'll stay lower forever. The central banks told us interest rates will stay lower forever. Savers that wanted to save money, they weren't getting any return on their cash. They're getting 0%, and people saying cash is trash. And yes, while the past 10 years cash has been trash, but what we're seeing during this crash is every asset that was meant to hedge against inflation is down. The only thing that's up? The dollar, the DXY. And this is something I was trying to warn people about last year, is inflation is good for assets until central banks start fighting it. And I said, a lot of people thinking gold and silver and Bitcoin will go up because of inflation. And I was saying that's already happened. Now what's going to happen is the Federal Reserve is going to fight inflation. When interest rates go up, the dollar will go up. And when the dollar goes up, most assets tend to fall. And that's what we're seeing now. And what I foresee coming, and what's already starting to hit the news, is there's going to be a flood of luxury items or discretionary items hit the market. We're going to see luxury homes start hitting the market in mass. Even where I live, I'm seeing the luxury homes in the area, they're starting to really increase in inventory. I'm starting to see them flooding the market. During 2020 and 2021, a lot of these premium homes, you couldn't find them on the market. But normally these, richer buyers or these more sophisticated buyers, they're more likely to try to time the market rather than, a middle-class family that buy a home because they just want a home, they love the home, and they plan to live there for 30, 40 years. These rich buyers or these sophisticated buyers tend to move a lot more, and they tend to try to buy the market because a lot of them are investors. And so I see them now in my area starting to put these $1 million plus homes on the market, and, there's this inventory skyrocketing. And what again is that'll be sophisticated buyers, but what it'll also be is a lot of people that brought in 2020 and 2021 and were thinking that debt will stay cheap for the foreseeable future, which we're seeing now. Debt is becoming very, very expensive. Also, what we saw, the car market in 2020 and 2021 went absolutely insane. Used car prices went up around 50%. People were paying about $10,000 over sticker price for new cars. Normally, you go to a dealership and you negotiate at a lower price. The dealership was saying, look, if you want this car, you're going to have to pay $15,000 over the sticker price if you want this car because of the shortages. Well, what we're going to see during this Great Depression, which we're going to have come again, which is highly likely to come again, we're going to see people not be able to keep up with these car payments, not be able to keep up with these mortgage repayments. And something else that is also happening in the housing market is property taxes in the US is skyrocketing. Here in Australia, we have council rates. Council rates are skyrocketing. And that's something a lot of people don't factor in. They just look at the mortgage repayment and say, yep, you know what, $2,000, $2,500 a month, I can afford that. But then they don't factor in the property taxes, and here in Australia, the council rates going up. So we're going to see not only sophisticated buyers start to sell, but we're going to see forced sales from these people that over leveraged. And we're going to see people that, inflation's killing them. They're going to say, look, we got the car here. The car market's been pretty good the past few years. Maybe I'll try sell it. And they sell a car for 20, 30, 40,000. And they try to use that money to get through the cost of living crisis that we're in right now. Like we see 20 million people can't afford their utility bills. Groceries are still accelerating at the fastest pace since 1979. That's right. The latest inflation data show groceries were going up the fastest pace since 1979. It's an absolute disaster. But my point of this video is cash will become king again. These people that have been punished for being frugal, for saving, having their purchasing power reduced, having to compete with people taking on debt to buy cars, boats, RVs, well, they're not going to have much competition anymore. And even people that want to buy a home, cash, if you're lucky enough to be in that position, well, you're not going to have to compete with as many people because they're not going to qualify for these loans when mortgages are above 6% now, and that's for perfect credit. For a lot of people that don't have perfect credit, mortgage rates are now above 7% in the US. And the same thing is happening in Australia. Mortgage rates are rising as well. So I think it's time to be patient. If you are looking to make a major purchase, like a home, new car, or even a new used car, an RV, a boat, I think just wait 6 to 12 months. You're going to start to see these luxury items, or even if you're not after a luxury item, just a good car, a good home, you're going to start to see inventory rise, and your time will come. Savers will finally start to get rewarded again with bond yields nearly at 4%. And that's something I want to talk about as well. There's something that was called TINA in the markets, meaning there is no other alternative. And they're telling these retirees, look, you got to invest in the stock market because you can't get a return on bonds. You can't get a return on your savings, so you have to go into the markets. And that's another reason they could justify these high valuations. Well, if we start to see bond rates go to 5 or 6%, all of a sudden there is an alternative. A lot of these retirees that sold all their bonds and went all into stocks, high risky growth tech stocks, they're going to go back into bonds to try to live off that 5 or 6% yield during their retirement. And with baby boomers being the wealthiest generation, that will be a lot of money taken out of the markets. We've seen during this crash, $7.5 trillion has been wiped out already. So that's another big thing I see that's a big risk for the market. They don't have this TINA excuse anymore. Bonds are going to start competing with stocks as yields rise, and also banks are going to start lifting their interest rates on their savings. So again, that's going to be more competition for stocks. And also real estate as well, because investors buy these homes for their rental yield, but yields are at such low rates right now, it doesn't make sense. So everyone, that's just some of my thoughts today, some of my warnings, something for you to think about. What do you all think? Let me know down below. Thanks for watching. You're all awesome. I'll see you all in the next video.